How to win in any part of the property cycle? Let's go. We're going to go through three main things today. First of all, what is a property cycle? The 4 stages of each property cycle, and then how to spot which stage each region's in. Let's start with what a property cycle is. You might think that property prices increase up and to the right forever, but that's not what we see in practice. Property prices sometimes increase, sometimes they decrease, but what they do is they follow a very predictable pattern of 4 key stages throughout a property cycle. Now, why does that happen? Number one is because of natural economic factors. Sometimes we might have very high net migration in New Zealand. That's going to increase demand for properties and push prices up. But then sometimes we see it go the other way. Like today, we have negative net migration, more people leaving New Zealand than coming to stay. That's going to depress demand and pull prices down. The second factor is humans or human nature. So when we see property prices increasing, we all pile in, add to the demand, and up go prices. Sometimes when we see property prices decreasing, we get a bit sheepish, we get scared, we hold back our purchases. That is going to depress demand and bring prices down. But what's important to note is that each of these 4 stages present opportunities for property investors because these 4 stages come around time and again, they're stable and they're predictable. So let's talk about how to win at each stage of the property cycle. The first stage is the boom. This is when prices start to rise, initially very slowly as they recover from the previous trough, and then they take off at a rapid pace. This is what we saw between 2020 and 2021 here in New Zealand. What else happens? We see media hype. You're going to read headlines like more buyers than sellers. And what's that going to do? That's going to encourage people like you to bring your property purchases forward. So if you see a lot of media hype, if you see property prices increasing, you might think, well, I was planning to buy a holiday home in 2 years, I better do it now, otherwise prices are going to increase. Let's say you were thinking about buying an investment property 5 years down the line. You might say, I better do it now because I want to get the benefits of that capital growth. Now, if you're bringing your purchases forward and doing it today rather than later, that's going to increase demand today. And what do we get? Self-fulfilling prophecy, property prices increase. So how do you win during the boom? First of all, buy early, ideally before the boom has even started. So I'm talking about buying in the trough. Look, if you're only buying once you see property prices increasing and increasing for a couple of months, so you've got the confidence that there's a trend there, it's too late. By the time you make that purchase, by the time you get into the market, you've already lost some of that opportunity. Better to get in right at the start. Second thing is to get into the market in the first place because you can't get the benefit of increasing property prices if you don't own any property, but then stay in the market to get the long-term benefit of capital appreciation. Because if you sell out too early, what's going to happen? You're not going to get the benefit of rising property prices over the long term, but then you are also likely to have to pay tax under the bright line. Second stage is the peak. This is where buyers start to lack confidence. Property prices are higher than they've ever been before, and you might think, can they keep going up? That creates doubt in buyers and we start to pull back. Other thing is rental yields quite low at this point because property prices during the boom phase increase at a faster rate than rents. And then we start to see prices plateau. Now, sometimes this happens, sometimes it doesn't. But let's look at the 2007-2008 peak of property prices. Well, once they peaked in about May 2007, they actually stayed the same for another 10 months before they started to come down. That doesn't always happen. For instance, if we look at the more recent peak of November 2021, property prices increased, peaked, and then they started to decrease in the next month, December 2021, coming into that downturn phase. So how do you win? Number one, buy well, but more importantly, hold. I'll give you an example of what I mean. In 2007, Opus Partners Managing Director Andrew Nicol bought this property and settled it in October 2007. Now, that was just after the peak of property prices in the Waimakariri district because this property was in Rangiora, about a 30-minute drive from Christchurch. Now, as soon as he settled that property, what happened? Prices dropped 16%. And you might think, well, Ed, that doesn't sound like a win to me. But what he did was he held that property for another 15 years. And over that time, from the peak, property prices have increased 95%. So he bought it for just shy of $400K. Today it's worth about $820,000. So he's made over $400K. The key here isn't that, did he buy at the right time? Well, to be fair, he didn't buy at the most opportune time, but he still made a significant amount of money. How did he win? Because he held for the long term. Now let's get into phase 3 of the property cycle, the downturn. This is when prices are falling, the number of listings on the market or the number of properties available for sale are increasing, and the number of property sales are falling. So at the peak of the market, we saw about 100,000 properties sold within a year in New Zealand. Today, that's got about a 7 in front of it. So we are seeing the number of properties that are selling decline. This is going to cause a lack of confidence and cause property prices to fall further. So how are you going to win during the downturn? Oh, this is my favorite part of the property cycle because you get to negotiate hard. This is where the best deals are found in the downturn. And that's because no one knows where the bottom of the market is. So it takes a brave person to get in, negotiate hard, and take that chance. And if you decide to do it, you will be rewarded for it. For instance, if you're an Opus investor, just remember we're negotiating that deal on your behalf to get you the best deal. The second thing you're going to have to do to win in the downturn is be brave, because there are going to be people telling you that you're an idiot. They're going to be telling you that property prices are going to decline and it's a terrible financial decision. That's what you want. Because if there are fewer people out there buying properties, that gives you the chance to get in, negotiate hard, and get the right deal. Now let's get into the final phase of the property cycle, the trough. This is where prices are at their lowest point, at least market prices, and they start to flatten out. But here's why you don't get as much opportunity to negotiate during the trough, because people start to feel confident again. You know where buyers tend to be the least confident? When prices are either increasing very quickly or decreasing very quickly. Once they start to stabilize, whether at the peak or at the trough, that's where people get more confident because they've got an understanding that property prices are likely to be the same in 3 months as they are today. Now that limits your ability to negotiate, but there are still 2 ways to win. Number 1, have confidence to make that decision even though property prices have fallen, but also secondly, buy in an area that's more likely to take off again sooner rather than later. And I'll show you how to figure that out in a moment. Now let's talk about how to spot where each region is within its property cycle. But if you're enjoying this video, make sure you hit the like button and the subscribe button so you get notified about all our future videos and don't miss out on them. Okay, one of the big issues when you're looking at house prices or a graph of house prices is it can be really hard to spot where the booms, the peaks, the troughs and the downturns are when you're just looking at the graph. Well, that's why here at Opus Partners we use a slightly different model. Here's how it works. We look at where is a region's house price compared to everywhere else in New Zealand. Now, that helps us look where Auckland house prices might be relatively cheap compared to the rest of the country, or similarly where they might be a bit more expensive. Now, the other good thing about this graph is it tends to show us more of the peaks, the troughs, the booms, the downturns that we've just been talking about. Much easier to spot these compared to when we're looking at a graph of those house prices. I'll give you another example. Here is the same data, but for Canterbury. Here we can see that for a long time, Canterbury was on the decline compared to the rest of the country, and now we're starting to see that recovery, that boom relative to everywhere else. Now, there are some pros and cons to using this data. Number 1, much easier to spot the trends compared to just looking at prices on their own. And the second thing is it is going to help you find the right place to invest, especially at the trough, because that's important. Cons of using this data, only got 1 point of comparison, New Zealand house prices. Now, what do I mean by that? This data isn't going to tell you whether it's the right time to invest in New Zealand property or not. But what it will tell you is, given that you want to invest in property, where's the best place to do it? Now, you can find that data completely for free at opuspartners.co.nz, or we'll link it down in the description.